Mickey Dickey here, doing my weekly update. And this week I'm going to start with the stocks that I'm looking for the week of May 15th through the 19th. Again, these are stocks I'm looking for trends and ideas and thought processes. They're not necessarily stocks I'm recommending we buy, sell, hold, or do anything with. Again, Monday, really nothing. Friday, nothing. So in between's where we're looking at. On Tuesday, we've got Home Depot, we've got C, we've got Baidu, and Vodafone. And those of you who don't know, Vodafone is basically, in my opinion, the Verizon of Europe. Has a very solid dividend, has not done well, just like Verizon hasn't done well. Wednesday, you've got Cisco, you've got TJ Maxx, Target. Thursday, you've got Walmart, Alibaba, and Ross Stores. So again, very heavy on the retail. And what I'm really looking at is to see the underlying trends and what the comments are from each of these different companies as to how things are going. Target, have they got their supply chain stuff under control? How are they looking going forward for the consumer? All of them are looking for the underlying consumer. Again, not a ton of stuff that I'm looking for this particular week, but this is what I'm looking at for next week. Now, the question is, what has happened? So what we're looking at here is what happened last week. Now, just to recap, what we were looking for last week was CPI and PPI, and what ended up happening with the debt ceiling and banks. Those are the four major issues. So what we ended up with last week is the NASDAQ doing relatively well, and so far this month doing relatively well. And again, these are not spectacular numbers, but they're not going backwards, which this is really what we're looking for. Until we get the Fed paused, until we get the banking situation dealt with and the debt ceiling dealt with, treading water is pretty solid at this point. So far, last week we had the NASDAQ up 0.4%, we had the S&P down 0.29, and the Dow down 1.1. That leaves us total for the month of the NASDAQ up 0.48, the S&P down 1.089, and then the Dow down 2.3. And year to date, we're still up 17% on the NASDAQ, we're up 7% on the S&P, and 0.46 on the Dow. And the overall trends that we're looking at, or at least I'm looking at, is that we're still up 22% from the bottom on the NASDAQ, 18% from the S&P, and 16% on the Dow. Now, we keep talking about this trend, and we've continued to say over the 20% mark for several weeks and months, which is a huge number for me. And I know it's just a number, but I think there's something to it. Now, we're still down 23% on the NASDAQ. We're still down 13%, almost 14% on the S&P, and 9.5% on the Dow. But these are the trends we need to continue to look at. Because there's still this disparity, we need to continue to see this, and we need to continue to see these numbers here. And it should go that way. And the reason it should go that way is just what we found last week. CPI was down a little bit, 0.1%. But again, I don't like to look at these numbers on an individual month basis. You have to look at them year over year. I get it. But when we talked at the beginning of the year, I really expected to be around 5%, and we're at 4.9. So we're within a tenth of where I expected us to be. The May's print that comes out in June, gas prices last year went up. They seem to be going down, or at least not going up this year. So that should bode well for May's print in June. June's print, as we talked about, is the high point at over $5 a gallon. We're not going to be there, or shouldn't be, barring something odd. The next 2 and probably 3 months should continue to see inflation go down. The question is just how much. If we can get into, if we end up being at 4.5 and then 4 and into the 3s, which I think is very possible by the time we get the July print in August, could very well be where we want it to be. Hopefully thumbs up on that. But the question is, why is that important? The reason that's important is the reason the NASDAQ is down so much is because inflation and because of the premium that everybody's put on growth and how it's just been sold off. Once inflation is brought under control and we know that the Fed is not moving, we should see this stuff continuing to go up, which we are. So even though last week we still had the debt ceiling issue and we still had the banking issue, we continue to see growth go. They shouldn't be a major problem for either one of those. This is the tech sector. It shouldn't be a major problem with banking and the debt ceiling. And AI should help all of this stuff. So this all should be very growth. It should be a big return. So once the debt ceiling is dealt with, and it will be dealt with, I'm not sure when, whether it's tomorrow or a week from now or 2, I can't give you an exact time. I wish I could because it's the government and it makes absolutely no sense what they're doing, but it will get dealt with. And once that's dealt with, the bonds, the interest rates, all of that's going to settle down, which is going to make the banking situation settle down. So what you're probably going to see is a continued lag in the Dow and the S&P behind the NASDAQ. Because once the debt ceiling's dealt with, this is ready to run, clearly. When you're seeing, even with everything over its head, it's still rolling up, it's ready to go. Now, the question is, how far does it go? Because at some point, we're going to run into some problems. We're probably will run into some problems where the economy is just not going to be able to hold up with what we've done to it. Now, hopefully it will. But again, there's no guarantees on any of that stuff. So my question on all this is that I do think we'll have a nice run here over probably the next 60, 90 days. And that's why I watch these trends to make sure. And again, more specifically in this market here. So what I'm looking for going forward, besides the stocks we already talked about, is there's not a whole lot coming out this week. So what's going to fill that void? Little bitty market indicators and little reports that come out and forecasts that come out that would normally no one would really care about are going to do things to the market. They're going to change the market. So I think on a short-term basis, anything that comes out that's negative on the economy is probably going to have a small uptick in the market itself, because again, it's going to continue to push the Fed to stop. And I think that's a good thing on a short-term basis. The question is, did the Fed go too far? And we're going to start hearing that from everyone. They continue to talk. They keep moving this stuff back. I was listening to somebody talk about this on the news this morning, saying that I should have started in 6 months after basically in 2020, they were talking about starting to raise. And I'm like, dude, well, we were getting vaccines. Again, it's easy to be revisionist. The question is going forward. We don't know how much damage is being done right now. I'm hoping that nothing is being done. I'm hoping the market will walk through all this stuff and deal with it. I don't think it's going to be a major issue one way or the other. And using terms like recession and all this stuff really bothers me, because it self-perpetuates itself, and it also makes it so that people don't really understand what's actually going on. And the fact that when you look at where the market is going, even if there are blips along the way, we don't have to have labels for everything. We really don't. And I know the market tries to, and they do it because they want to have people watch the news and stuff, but in reality, it doesn't have to be labeled anything. Yeah, we're going to get a run. Let's just say the NASDAQ goes up another 5% from here, which is not out of line. We end up going up 5%, so we're going to be up, say, 22% on the year. Okay. Does that mean if it goes backwards after that point, people start selling off, take some profit off the table from the bottom, that we're back in a recession? No, we're in a normal market cycle. I would expect something like that. The market doesn't normally go all straight up. It doesn't go straight down. I would expect it to make some gains and give some back. Make some gains, give some back. And the same thing on the way down. It goes down too far and then it makes some gains. So those are the trends I'm continuing to look for. The trends I'm seeing here are going in the direction we expect them to go to. I expected these a couple of months ago. The debt ceiling and the banking crisis, I think, mucked some of this stuff up and pushed some things off, which I think actually extends out when, if we have a recession, when it will happen. So this is what I'm continuing to look for. These are the trends I'm seeing, and I will continue to look for. The next trends I'm going to be looking for, as I keep talking about, where is unemployment and where is real estate year over year? We don't have those numbers out yet, but when we get those next numbers, that's going to be, to me, the next step in where are we going rather than where we've been. Because if unemployment continues to stay where it's at and does not deteriorate, and real estate continues to level off and again not deteriorate, that to me shows us that we're not going into what we would call a true recession. And we'll really know, because at the end of May, which the numbers should come out in June for real estate, because that was the all-time high. And unemployment, we just have to keep seeing where those trends continue to go. Now, is that going to tell us where we're at a year from now? No. If we're continuing to stay at the 3.5, 3.7, 3.6, 3.8 range, those are great unemployment numbers. And if real estate comes in around 2, 3% or under, or 0, or anything in that range, is a positive because of how much we've gone up. We just don't want it to be a negative too far down or too far high, which I don't think too far high is going to be an issue. We went up 17% and then 20%. I don't see us going up significantly because at this point we're still down year over year. Or not year over year, but since June. Year over year, we're still holding. Not to say that your specific market may not be down. There are markets that are down year over year. I'm saying nationwide, and that's how you have to look at these numbers. You can't break it down by different category because that's not going to have a major effect on the overall stock market. I'm looking at bigger trends and what's going to affect the market. So to me, the next big catalyst are going to be unemployment, real estate once we deal with the debt ceiling, once we deal with inflation, which I think is already handled. And those are going to come to a head in June. Hopefully the debt ceiling will get dealt with in May. But the inflation part should be dealt with at the next Fed meeting. And I do think it's going to get handled. I think he's going to have to come out. I shouldn't say have to. I think he's going to come out and say, we're going to pause here, see what's going on, see where things are. Not that they won't be willing to do more if need be. And that's which is going to be a hawkish pause. And that's okay. I think the market's fine with the hawkish pause. So what you need to do is make sure that you keep your portfolio where you need it for the long term. I don't see any major long-term issues. Again, there might be some short-term hiccups along the way, and that's okay. But get with your financial advisor. Make sure your portfolio is set for the next 5, 10, 15 years, however long you have, based upon where you're at in your financial cycle and where your long-term planning is. But stick with your long-term plan. Don't allow short-term blips to affect your long-term planning. Because I want to make sure that you can retire when you want to retire and how you want to retire. Dickie out.